Greetings everyone, my name is Tsofatso Mahuma, and in this screencast I will be dealing with some of the calculations for the preparation of the statement of cash flows. We will be looking at the calculations for dividends received, which can also be used to calculate acquisitions or disposals of investment in associates, joint ventures, and/or equity instruments. We'll also be looking at dividends paid as well as tax paid. As we're going through the examples, keep in mind that the statement of cash flows is there to present information to the users of the financial statements on how the entity generated cash and how it used the cash. This is the actual cash that was received or paid out by the entity. The standard should be utilized effectively, and by this I mean that you should know where to find what. In terms of the statement of cash flows, you can be requested to present the statement in either the direct method or indirect method. Please read the required carefully, as the provision of an incorrect format will not be marked. The format can be found in your IFRS under IAS 7, Illustrative Example 18A for direct method, and Illustrative Example 18B for the indirect method. It is important to ensure that you know all the possible notes to the statement of cash flows which can be required of you to prepare. Remember to only prepare the notes as part of your solution if they are specifically required. The following notes can be required of you: obtaining or losing control of a subsidiary, non-cash items or transactions, cash and cash equivalents, additional information or other disclosures, discontinued operations, which is not examinable for FEC 4862, but important to know for FEC 4864. Please go have a look at the notes to the statement of cash flows included in the illustrative examples. This will assist you in the structure of the notes as well as ensure that you include all relevant information in the note. Now let's start with dividends received. The movement in the investment in associate or joint venture account or equity instruments can be used to calculate either dividends received, investments acquired, or disposed of during the year. The information given in the scenario should lead you in determining what to calculate. Let's consider a scenario where you're provided with the opening and closing balance of the investment in associate account. Note that this information could be provided in the statement of financial position or trial balance. You're also given the share of profit of associate, as well as being told in the scenario that there were no other acquisitions or disposals of associates during the year under review. The easiest way to make sense of the information is by putting it in a T account. I would urge you at this point to pause and attempt the calculation before continuing. Let's think about the journals that would have been processed to account for the information provided, as well as consider how the T account will look like. When receiving the share of profits of associate, one would debit the investment in associate and credit the share of profit in associate. The dividends received would have been accounted for by debiting other income and crediting the investment in associate account, which in this instance will be the balancing figure on the investment in associate account. Now let's consider the same information. However, this time the scenario states that there was a disposal of an investment in associate and that the carrying amount on date of disposal of this investment amounted to 80,000 rand and no profit or loss was made on the investment. The balancing figure of 40,000 will be the dividends received. The dividends received will be accounted for separately on the face of the statement of cash flows, and the cash proceeds from the sale of the investment will also be disclosed separately on the face. In some instances, the dividends received will be provided, and the balancing figure in the investment in associate account will either be proceeds from the disposal or cash paid for acquisitions. The same principle as above can be applied to the investment in equity instruments account in order to calculate the dividends received or acquisitions or disposals. Next, we're going to look at dividends paid and the relation with the shareholders for dividends account and non-controlling interest account. Dividends paid consist of two streams: dividends paid by the holding company and dividends paid by the subsidiary. Consider the information provided in the scenario. You have been given the shareholders for dividends, non-controlling interest, and dividends declared amounts. There was also a disposal of a subsidiary, and the non-controlling interest at the date of disposal of the subsidiary amounted to 200,000. Furthermore, you're given the profit attributable to non-controlling interest. You can assume there was no other comprehensive income. I would urge you to pause and attempt before continuing. It is important to determine the non-controlling interest share in dividends declared by the subsidiaries, which is the reason why the non-controlling interest account is reconstructed. Once you have the dividends declared to the non-controlling interest figure, which in this case is 60,000, the amount is transferred to the shareholders for dividends account. The dividends declared by the parent will be reflected in the shareholders for dividends account, and the balancing figure in this account will be the cash dividend paid to shareholders. The balancing figure of 128,000 is what will be transferred to the face of the statement of cash flows as dividends paid. Lastly, we're going to look at the income tax paid calculation. The income tax expense, as per the statement of profit or loss and other comprehensive income, includes the movement in the deferred tax asset or liability, which is a non-cash item and should be excluded from the income tax expense when calculating the tax paid for the period. Now let's consider the information provided in the scenario. You have been given the tax payable, deferred tax, and income tax expense figures. Attempt to calculate the tax paid prior to continuing. When accounting for the income tax expense, you debit the expense and credit your tax payable account. And to account for the net movement in your deferred tax account, which in this case is a liability, the decrease will be credited to your tax payable account. The 35,000, which is the balancing figure in your deferred tax account, will be taken to your tax payable account, and the tax expense of 45,000 will be accounted for accordingly in your tax payable account. The balancing figure of 115,000 will then be your tax paid, which is disclosed in your statement of cash flows. We have come to the end. Thank you for watching and all the best with your studies.